Hi, I'm Steve LaFrance with Blakely Financial. Didn't even have time to complete a July market summary before a substantial amount of economic activity took place just the first few trading days of August. We've clearly hit a new patch of market volatility, so let's discuss why. The investment narrative changed after the inflation report in late July showed continued progress, with PCE now landing at what Jerome Powell called a somewhat elevated 2.5%, inching closer to the Fed's 2% target. The better-than-expected report raised market expectations for a September interest rate cut, leading to a significant rotation within equities. Investors moved from large-cap stocks into small caps, with the Russell 2000 outperforming the S&P by over 9%. This year's high-flying mega caps sold off as investors question when billions of dollars in AI investments will pay off, which justifies the continued need for diversification. Around that same time, the second quarter GDP report showed the U.S. economy expanded at a robust 2.8% annualized rate, double the rate seen in the first quarter. So when the Fed met on July 31st, the rate remained unchanged. However, their forward guidance has given the markets reason to believe a rate cut at the September meeting will be a near certainty. Jerome Powell talked up inflation's recent progress, saying, quote, "The second quarter's inflation readings have added to our confidence, and more good data would further strengthen that confidence," end quote. He also conveyed that since the job market seems to be back to pre-pandemic normal, any additional cooling could be concerning for the Fed. This was followed by a series of reports showing weakening positions in the job markets. The BLS job openings dipped slightly to 8.18 million jobs. The ADP employment report showed only 122,000 jobs added last month, the lowest value in 6 months. The BLS non-farm payroll report also showed a below-expected 114,000 new jobs. Initial jobless claims climbed from 235,000 to 249,000, bringing the unemployment percentage from 4.1% to 4.3%. From a historical perspective, none of these are horrible numbers. It's just the fact that they are trending in a negative direction, which has the markets concerned, and some analysts calling for the Fed to initiate a 50 basis point cut in September or consider an intra-meeting cut soon. Meanwhile, global markets have gotten off to a rocky start in August as expectations are being readjusted. There are no real surprises here. We have basically arrived at one of the most anticipated moments in recent Fed history, where they've been following a data-centric approach to rein in inflation while minimizing the impact on jobs. And we're now seeing the first real signs that this very delicate process is fast approaching an inflection point. A rate cut may soon be necessary, but how much and when? Who knows? But a couple of positive notes to consider. Second quarter earnings reports continue to come in strong, and the unemployment data shift is primarily coming from new entrants in the labor market, not from company layoffs. So some of the current market fear may be overdone. We're at a point now where it appears a rate cut could be implemented without reigniting inflation and provide some relief to interest rate sensitive businesses and markets. That's all for now. We'll continue to provide timely updates, so enjoy these last several weeks of summer. Take care of yourselves, and thanks again for your trust and confidence.